Hello and welcome to RichInsider. Today we plunge into the heart of China's economic downturn, unfolding at a pace few could have predicted. The current state of China's economy presents a picture of alarming trends that are impossible to overlook. China's debt-to-GDP ratio reached a record 288% in 2023. From the implosion of the property market to the downturn of the stock market and the mounting deflationary pressures, the economic landscape of the world's second-largest economy is shifting dramatically. China's property market, long considered a pillar of its economic stability, is now a ground zero of worry. An over-reliance on real estate for both wealth creation and local government funding, coupled with years of unchecked speculation, has led to a bubble that's now bursting. This collapse is sending shockwaves through the entire economy. Simultaneously, the country's stock market is suffering from extreme volatility. Investor confidence is waning, and the fear of instability is leading to a self-fulfilling prophecy of decline. The result is a dramatic downturn that's eroding wealth at a rate unseen in recent history. Stock investments are down by 30%, salary packages by 30%, and investment property market has decreased by 20%. But these are just the visible symptoms. Beneath the surface, China's economy is grappling with deflationary pressures. A decrease in consumer spending combined with an oversupply in various sectors is leading to a dangerous situation where prices are falling. This deflationary spiral can potentially choke economic growth and create a vicious cycle of decline. What's causing this economic crisis in China? Well, it's a mix of internal and external factors. We can't overlook the role of government policies and regulatory actions in this situation. The central reason for it is that Xi Jinping has decided to make national security and technological upgrading, not economic growth, his policy priorities. Years of debt-fueled growth and oversight have led to an unsustainable economic model. When the government started tightening regulations and reining in debt, it inadvertently triggered a domino effect of economic contraction. Xi's third contribution to China's woes is his COVID policy that kept the Chinese economy under lockdowns longer than the rest of the world, impacting business growth. Further global trade tensions and a slowdown in the world economy have added to China's economic woes. The result is a potent mix of challenges that are testing the resilience of China's economy like never before. As we continue to unravel this crisis, it's crucial to understand the intricacies of these issues and their potential implications for both China and the global economy. The economic crisis is not only shaking up the macroeconomic landscape, but also hitting Chinese households hard. With the downturn, household wealth is taking quite the hit, particularly due to the erosion of property values and investment losses. The property market, once a dependable source of wealth, has imploded, leaving many homeowners underwater. As property values plummet, families are finding their net worth decreasing and their financial stability threatened. 70% of family assets are tied up in property. Every 5% decline in home prices will wipe out $2.7 trillion in housing wealth, according to Bloomberg Economics. Beyond the property market, the stock market's volatility has also led to substantial investment losses. Imagine the dismay of investors who, after years of steady returns, are now seeing their portfolios dwindle. As households reel from these losses, people tighten their spending and brace for what might come next. As a result, businesses suffer from decreased consumer demand, leading to a catch-22 that further exacerbates the economic downturn. This cautious approach to borrowing and spending bears a striking resemblance to the challenges the United States confronted during the Great Depression. The economic downturn is also posing significant risks to China's financial system. Concerns are growing around banking stability and market volatility. But the impacts of this crisis are not confined within the borders of China. The potential instability and spillover effects of the Chinese economy on global financial markets are immense. China accounts for around 40% of global growth, with so much more exports than it imports. Investors worldwide are watching closely, with many re-evaluating their exposure to China. This heightened risk perception could lead to capital flight, further exacerbating the crisis and potentially causing ripple effects across global markets. Now let us turn our attention to the steps Chinese authorities have taken to manage this economic crisis. Chinese authorities have responded to the crisis with a range of intervention measures. To stimulate growth and ease the pressure on businesses and households, they've made significant interest rate cuts. This approach is intended to make borrowing cheaper, encouraging spending and investment to rekindle economic activity. In addition to this, the authorities have injected vast amounts of liquidity into the financial system. The aim here is to ensure banks have enough cash to meet their obligations and continue lending. If executed well, these measures can alleviate immediate financial stress, offering a lifeline to struggling businesses and households. But the question remains, how effective have these measures been in stabilizing the economy and restoring investor confidence? There's no straightforward answer. While some stability has been achieved, it's clear that these measures are not a panacea. They've helped to mitigate immediate economic shocks, but have done little to address the underlying structural issues plaguing China's economy, which brings us to the future outlook for China's economy. The International Monetary Fund projects China's 2024 growth at 4.6% and 4.2% in 2025, a lower performance than in any of the 25 years before COVID-19, declining towards 3.5% in 2028. In the short term, recovery prospects hinge on the effectiveness of these intervention measures. However, their success isn't guaranteed. A lot depends on how well the authorities manage to stimulate growth while containing financial risks. Looking at the long term, the structural challenges are even more daunting. To foster sustainable economic growth, it's essential to address underlying issues like the massive debt overhang and regulatory uncertainty. Debt overhang, in particular, is a critical concern. The high levels of corporate and local government debt could potentially derail recovery efforts. It's like trying to run a marathon with a heavy backpack. It slows you down and drains your energy. For China to regain its economic vigor, it's crucial to lighten this load. Another issue is regulatory uncertainty. Inconsistent policy signals and abrupt regulatory changes can unsettle markets and deter investment. To restore confidence, authorities must strive for greater policy consistency and transparency. In essence, the road to recovery will require both short-term measures to stabilize the economy and long-term reforms to address structural issues. But if navigated wisely, China could emerge from this crisis stronger and more resilient. So what are your thoughts on the Chinese economy? Will China come back strong from this economic challenges it's currently facing, or other countries will soon surpass China? India might have the potential to challenge if China's progress continues to decline, but India has a lot of work to do before it can even think of competing China. Let us know your views. We'd love to hear from you. Until next time, take care.